life insurance at all. We have no life insurance represented here. If we're going to represent life insurance within this picture, we're going to have to take some money out of here. And we might do something like this. We might have a couple little taps here where we're going to take some money out. And the money that has to come out, and you should remember this from Module 3 and then again from earlier in this module, that there are 3 components to the pricing of a life insurance policy. We've got the investments already taken care of here, and then we have to pay for mortality, or what we could call cost of insurance, and we're also going to have to fund the expenses of the insurance company. Now, the mortality costs will depend on some of the other characteristics here. Our mortality costs are going to depend on how we initially set up our premium structure, also are going to depend on how we've chosen to go about building the coverage for this policy. So the first thing we'll look at is the actual cost of insurance structure. With a universal life policy, there are 2 types of cost of insurance available. We can have what you might recall from earlier in this module would be referred to as a YRT, or a yearly renewable term cost of insurance. And with that yearly renewable term cost of insurance, in the early days, your insurance cost is going to be relatively cheap, but as you get older, it's going to get more and more expensive. Or, you might also remember, we could have a level, or sometimes we'd refer to this as T to 100, cost of insurance. It depends what we're looking for. Normally, a client who's younger and investment focused might choose a YRT premium structure initially. And that YRT premium structure will keep their costs down, allowing them to put more money into the policy. That is, more money would stay with the account value. If we have somebody who's maybe a little bit older or less investment focused, they might use a level cost of insurance. And with the level cost of insurance, they know that they're not going to see that increase in their cost of insurance later on in life. Some insurers, in fact this is quite common today, will allow you to initially purchase a YRT structure and then at a predetermined point switch that YRT over to a level structure. This is almost like the best of both worlds. You have that low cost initially, and then you're going to switch to a level structure later on, so you'll never see your prices increase to a point where they become unmanageable. But keep in mind that at the point where you make that switch to a level premium structure, the cost of insurance at that point is going to be based on your age when you make the switch, not on your age when you originally acquired the policy. So it's not cheap to do that. Now, within the policy, there are 4 different death benefit options that we can choose. We're going to talk about that again in a minute. The thing to remember here is that when we're taking money out to pay for mortality, we have to take into account the cost of insurance that we've chosen. We also have to take into account which of the 4 coverage options we have chosen. Whatever doesn't come out to pay for mortality or the expenses of the insurance company, which we also call the policy factor or policy fee, you will recall that from Module 3. Whatever doesn't come out to pay for mortality or expenses is going to stay in the account value and go into whatever type of investment our policy owner has chosen, and we'll start building up that value now. Okay, before we go on to the 4 different death benefit options, I will take a moment to talk about this transparent or unbundled characteristic of this policy. And it's useful for understanding this transparency to compare this to a whole life policy. You might recall from the whole life policy that within the whole life policy structure, we have premiums being paid, and we knew exactly what those premiums were going to be. There was no doubt what the premiums were going to be. And we had a death benefit that was also known. Of course, with a non-par policy. With a par policy, we saw there was some opportunity for some flexibility here, but you know with any whole life policy, it's always going to be at least what the promised amount is. So we had a death benefit as well that was promised at the point at which death occurs. And we also had a cash surrender value, and you'll recall that that cash surrender value was also a known amount. As the policy owner, you didn't have to do anything to take advantage of this situation except pay your premiums. And what happens here in the interim is really not something you have any exposure to. This is all done by the actuaries who work at the insurance company. Their job really is to make sure that your promises get met as long as you continue to pay your premiums. So a whole life insurance policy, very simple. There's nothing to worry about as far as managing the policy later on. Whereas in a universal life insurance policy, you really do have to manage this policy. So if we can look at the same characteristics here, we have flexible premiums. We don't know what they're going to be. We have flexible coverage. We don't know exactly what the death benefit's going to be. And we have flexible investments. We don't know exactly how much is going to be in the policy. So you pay your premiums, you're not sure what your death benefit's going to be, you're not sure what your account value is going to be, but while you own the policy, you will have complete visibility as to what's happening with your policy, and it's really up to you to make that work for yourself. So we can see the difference between the policy owner's responsibility with a whole life policy and the policy owner's responsibility with a universal life policy. The person who acquires a universal life policy and doesn't pay attention to it, if they get lucky, it might work out for them, but they're not paying attention. This thing could all not work out the way it was expected to. If we're counting on somebody taking care of their policy, then this is where we're going to go. If we have a client who's going to take a hands-off approach, this is probably the better approach, the whole life policy. Okay.